Tata Motors has not found its way out of the woods as yet. The auto giant reported a quarterly loss, you might argue yet again. Yes, yet again, for the fourth time in 5 quarters. Sales fell for both Jaguar and Land Rover and parent Tata Motors. Yatin Mota is here to sum up what went wrong for the company in the quarter gone by and what does he make of the results, what our brokerage is making of what could happen to the stock. Yatin, a lot of questions unanswered. Good morning.
Good morning, Neeraj, and more importantly, a very weak set of numbers from Tata Motors. More importantly, if you look at the revenues, they fell by nearly 7% year on year. The EBITDA on an absolute basis was at close to 3,800 crores. The expectation was close to 4,000 crores. And also, if you look at the loss, that came in at close to $500 million or 3,680 crores, almost doubling that loss on a year-on-year basis. Margins also fell to a level of 6.2% versus the expectation of 7%. Last year, the same period, the EBITDA margin was 7.5%. So the improvement really not seen as far as Tata Motors is concerned, be it the standalone result or be it the consolidated earnings, JLR, everywhere there was disappointment on the operating front. In fact, if you look at JLR, the revenues were down 3% at close to 5 billion British pounds. Also, if you look at JLR margins, that came in at a muted 4.2%. The street was working with a figure of 5.2, and this 4.2 margin was almost a 200 basis points decline on a year-on-year basis. Of course, standalone, some silver lining, but nothing great there. The EBITDA margins continue to remain under pressure, which came in at 6.7% versus a level of 8.4%. Finance cost, more importantly, increased by 336 crores for the quarter to come in at 1,700 crores. Of course, this was also to do with the Ind AS related adjustments which happened, which includes a 112 crore lease liability. Of course, that was set off by lower depreciation. On an overall basis, the management did indicate that the Ind AS adjustments were neutral to the earnings and EBITDA figures at this point in time.
So the question is the pain going to ebb anytime soon? Did the management give any kind of clear indication?
Neeraj, we spoke to the management. We were on the media call. When I asked the management first relating to the overall Ind AS impact, they say it is neutral. However, because of Ind AS, the net debt position of the company has gone up by 6,000 crores. And also, more importantly, this time there were no free cash flows. In fact, there were negative free cash flow by nearly 700 million pounds odd for JLR because of higher investments. The management, however, sounded confident about China, wherein they are expecting the markets to stabilize. And this is one big thing that the management spoke about to the analysts as well as to the media, that now the new Evoque launch, probably another few products in the Chinese market will aid the sales. Remember, Evoque was one big blockbuster product in China, and the new Evoque probably is expected to create excitement according to the management. So the China market will move forward. As far as the leadership change in UK is concerned, we have the new Prime Minister there, and the management also indicated there that the new leadership probably will get a faster resolution of Brexit, and there could be some better deal moving ahead according to them. Of course, in the first quarter, why there was a blip, the management said that they kept the JLR plant shut down for 1 extra week than anticipated, and because of the higher costs, the margins as well as the operating performance was quite muted. Of course, let's talk about brokerages quickly. Phillip Capital has cut the target price to a level of 161 from the level of 237. They do believe that despite the management giving and maintaining the guidance of 3 to 4% EBIT margins, there is a downside risk there. Morgan Stanley also has a lower target price to the current market price. They maintain an equal weight. They say that the first quarter earnings missed estimates largely to do with the weak performance of JLR, and also the net debt is slightly higher, which is a cause of concern. However, Morgan Stanley believes that the valuation is cheap, but they still await a volume turnaround, which the management said that could be the case moving ahead, especially for the Chinese market.
So largely a few negatives. Brokerage is mainly cut target. Don't expect a very heady day for Tata Motors today.
Absolutely, Neeraj. The only silver lining is the management is maintaining guidance on the EBIT margin front. They are talking about China, stabilizing. They're expecting good volumes in Europe and US. So on an overall basis, valuations are supportive. However, the kind of earnings volatility and the losses that we are looking at, probably there is a lack of interest in auto sector in general. So let's see how really the stock reacts to this. The ADR was down close to 3%, so not much of a reaction seen as far as Tata Motors ADR is concerned.
At least the positive reaction is not warranted today. Yatin, thanks so much for putting that into perspective. That's Yatin Mota, Head of Research, talking about what he makes of the Tata Motors numbers.